Right, this video is going to take on a topic that lots of people want to know about at the moment, retail bonds. And the reason lots of people want to know about them is partly inflation. There's a problem at the moment, which is that inflation is creeping up. The retail prices index is stubbornly sitting just above 5% at the moment. That means that you need to find a home for your money that pays some income, because otherwise you are losing out to the tune of the retail price index as it eats away at the value of your investments. So people are looking around for a home for their money that is inflation protected, but also they're looking around for a home for their money that's relatively safe, but also offers a decent return. And for those two problems, you can turn to the so-called retail bonds market. Now, if you're used to investing in shares, you don't want to just jump into this market, because you will come a cropper. Retail bonds and shares share some similarities, but pretty important that you know the key differences before you dive in. So I'm going to cover 7 key differences between, let's say, putting your money into shares, whether that be National Grid shares or Tesco shares, as opposed to putting your money into, say, the latest National Grid index-linked bond, or putting your shares into a Tesco bond. And with those two companies, you could go down either route. So it's important to know, why you're doing it and what the differences are and what a bond will give you that a share doesn't, and vice versa. So 7 key pointers, and for anyone who gets lost on the first couple or thinks it's a bit quick, do check out my bond basics video, part 1 and part 2, and that will give you a slightly slower tour of the basic principles of bonds. So on this video, I'm going to assume that you've kind of munched that one up already, and you're quite happy for me to just go through some pointers, a kind of checklist, a kind of don't buy one of these things until you understand most of the following points. Okay, so let's start with point number 1. All right. Before you buy a retail bond, one of the reasons you'll be buying is income. So make sure you understand coupons. Okay, now if you buy a share, you get a dividend, or you hopefully get a dividend. That's paid normally twice a year, and the directors decide how much it is. So if you buy Tesco shares, the dividend yield, and I cover that in another video as a calculation, is a function of the annual dividend determined by the directors out of their annual profits pool, if you like, as a proportion to the share price. Now, with bonds, slightly different. Most bonds out there that you can buy, so-called retail bonds, because a lot of them you can't, they're saved for institutions, isn't it always the way? But the ones you can buy, called retail bonds, mostly carry fixed coupons. There's none of this, the directors deciding how much you get. You know how much you're going to get because they tell you up front, and it's the same every year. So for example, if you were, I'm not saying you necessarily want to, but if you were to buy a Tesco 5.5% bond, and there is one out there, basically you're going to get, for every £100 you sink in, £100 of so-called nominal value, you're going to get £5.50 gross every year. Not necessarily paid all at once, but every year. So it's not like a dividend where the directors could decide to cut it or increase it. You basically know what you're going to get cash in hand. So that's the first point. Second point is, on most of these bonds, it is fixed. So you're not going to get £6.50 next year or £3.50. It's going to be £5.50 every year the bond is issued. All right, so that's the first point. Now, National Grid's bond is different to all the rest. That's the one that's in the news, because it is inflation linked. So before you jump into that bond, you'd want to know roughly what you're getting. And there, the deal is slightly different. With National Grid, what they've said is, so I'll put them down as NG, National Grid, they'll pay the change in the RPI plus 1.25%. Now, this is a bit fiddlier. What they're offering is inflation protection. Okay, so what they're doing is, the exact calculation is a bit fiddly. What they do is they go back 8 months and look at the inflation rate 8 months ago, and then use the change in the inflation rate to calculate what you get now. So if you're buying the bond today, a bit fiddly, the first coupon is expected next April, and it will be based on the change in the RPI. Believe it or not, between two dates, February and August this year. Leaving that to one side, what does actually mean in practical terms? What it means is if during the period they look at inflation, inflation rises by say 20%, all right, you will get 1.25% plus another 20%, the change in the RPI over the period they measure it. So that would take you up to, you know, if the RPI had moved up by 20%, that would take you up to 1.25% times 1.2 to add 20% on. So that would take you up to 1.5% as a coupon, paid actually in 2 installments, normally 6 months apart. Okay, so understand the coupon. What I'm suggesting here is National Grid's is a bit fiddlier because they try to inflation link the coupon they're paying, but the other retail bonds usually carry a fixed coupon, and that's not true of shares, where you get a dividend and that dividend can change. So if you're buying shares, beware of that. Just because you get a decent dividend this year does not mean you're guaranteed to get a decent one next year. Whereas with these things, the fixed coupon version, say the Tesco one, at least you know roughly what you're going to get in your hand every 12 months. So there's point number 1. Okay. Point number 2 is understand the redemption date. So I won't write the word understand every time, you've got the hang of that one, but understand that bonds expire, if you like. Now shares don't. Shares are permanent capital. If you buy a Tesco share, in theory, that share will stay there paying you dividends and growing, the share price going up and so on, until Tesco goes bust. Okay, companies don't normally buy back their shares. They don't say this share redeems in 2020. It's just out there, it's permanent capital. Not true of a bond. Bonds have redemption dates. So the Tesco one I mentioned expires, if you like, in 2019 or matures in 2019. That means you can hold it into 2019, but then Tesco will buy it back. So if you like, if you buy the bond, you've lent them money and they'll be paying you back in 2019. National Grid, their bond has got a 10-year life. So these bonds have fixed maturities. And it's important to understand what you're going to get back on the redemption date. Okay, now, in the case of the Tesco bond that I mentioned, the Tesco retail bond, they talk about redeeming at par. All right, what that means is you're going to get a fixed £100 nominal value back, okay, in the redemption year 2019. The par value of a bond, which sets the fixed coupon, is £100. Now the price of the bond can change in the meantime. So bonds can go up or down in price between now and redemption. All right, so the bond might be worth £96 per £100 nominal, or £102 per £100 nominal. So like shares, the price can go up and down, but that nominal value determines what you'll get back when the bond's redeemed. In the case of a fixed bond like the Tesco bond. Okay, now that does mean that there is price risk in the meantime, and I'll cover that in just a moment. Don't think you'll buy this bond and it will just stay at a fixed price. It won't for the whole 10-year period. It will change in price, but at the end of that period, you know exactly what you're going to get back if you still hold the bond. Okay, shares, that's not true. There's no redemption date on a share. What you sell it for is what you sell it for in 1 year, 2 years, 10 years, and obviously you hope to sell it for more than you bought it for to another investor. Okay, so that redemption date is important. And it does affect the price of the bond, and we'll look at that briefly in a moment. And if you're not sure after that moment, check out my bond basics videos. Okay, now with National Grid, there's a quirk. All right, this is a different type of bond. All right, it's a bit fiddlier. With National Grid, what they're going to do is to say, actually, we're going to index or inflation link the capital as well as the coupon. So actually, if inflation keeps rising between now or over the next 10 years, let's say, you'll actually get your £100 nominal back plus an uplift to reflect the change in inflation over that period. And what's more, they've said, should we turn from inflation to deflation, you won't get less than your £100 nominal back. So there's a kind of floor on the worst scenario, if that makes sense. Because obviously prices can rise, or in theory they can fall. All right, so the RPI can be either going up or going down. Okay, so National Grid, just watch out for that. The par value is adjusted for inflation, which hopefully means you'll get more back than you would with something like a Tesco bond, where you get the £100 back. Okay, there's number 2. Point number 3 is this. Risk. Alright, there are two risks when you buy a bond. One is that the issuer goes bust, I'll call that default, and the other one is price risk. Okay, now that's true of any bond. Now, just cover this. With shares, you've got this risk too. How can you measure default risk? How do you know how risky National Grid is, for example? Well, all bonds have a credit rating. Okay, and in another video, I cover what credit ratings are, so I'll keep it brief here. But all bonds and all bond issuers get a rating from AAA, that's the highest one, all the way down to D, which is bad news. The investment grade bonds are BBB or better, and that's where National Grid comes in. Its bond, the one I'm talking about just now, has been rated BBB, which is investment grade. All right, that's the minimum you should accept, really. Otherwise, you are taking quite a risk. You're taking a risk that the issuer could go bust between now and say 10 years' time, in which case you are potentially not going to get very much back at all. All right, so shareholders need to be aware that companies go bust, but the difference with a bond is you get this specific bond rating. Personally, I'd look for BBB or better. Okay, so that gives you some indication as to whether there is a default risk and how much it is. Price risk is just saying, well, look, bonds go up and down in price. People get confused at this point. Yes, a bond has a fixed £100 nominal value. That sets the coupon, and in the Tesco bond case, it sets the value of the bond when it's redeemed. All right, but the other thing to just bear in mind is that in the meantime, over that 10-year period, the bond will fluctuate in value, and people get confused here. They go, well, that's like two prices. No, it isn't. In the meantime, over the next 10 years, while the bond's in issue, in play, if you like, investors determine the price. Okay, the nominal value is just a fixed quantity of the bond. It's like you can go into a grocer's and say, I want a pound of carrots, right? Well, that's the nominal value of a bond. It's a fixed amount of the bond. What you pay for a pound of carrots depends on supply and demand. Yeah, it's not necessarily the same £100 in the bond market as this fixed nominal value. So that's why the bond price can move up or down. So be careful. If you're selling a retail bond before it redeems, check the price, because otherwise you might get a nasty shock. It won't necessarily be some guaranteed £100 nominal value, it'll be the market price of the bond. Okay, so there's another thing to watch out for. Check the price if you're selling any of these things before they redeem. All right, now that's point number 3. Some of the other points are quicker, so let's deal with those. They're equally valid though, all things that you want to be thinking about before you just jump in and say, yep, let's grab one of these things as an alternative to shares. Okay, on that default point, financial services compensation, FSCS, Financial Services Compensation Scheme, just watch out. Okay, these retail bonds are not usually covered by the Financial Services Compensation Scheme. So essentially, if National Grid or Tesco were to go bust, do not expect the regulator, if you like, to step in and protect any amount you've invested. They would potentially, if you had, say, a bank deposit or something similar like that. You can check out the details at fscs.org.uk. But basically, with these things, you're not getting that guarantee. So bear in mind, you're not giving your money to the government here, or you're giving it to a company. Those companies can go wrong, they can go bust, and if they do, there is no Financial Services Compensation Scheme guarantee. So that's a quick point, but definitely worth bearing in mind. Next point, tax. Okay, are these tax efficient? Now, when you buy shares, for example, you will pay stamp duty. That's normally 0.5% up front, paid by the buyer. Okay, you will pay income tax on dividends, and you will pay capital gains tax on your profit on disposal, the difference between the price you pay and the price that you sell the shares for. What about these things? What about if you buy a retail bond? What's the story? Well, the story is quite similar. First of all, some good news. No stamp duty. Okay, so if you pile into one of these National Grid bonds, no stamp duty. So that's a good start. However, you will be taxed on your income, on your coupons, okay, at what's called your highest marginal income tax rate. So essentially, the tax man looks at your salary and stacks any interest you earn on top, and then looks at the rate you should pay. So to translate that, if you're a higher rate taxpayer because of your salary, you will be paying higher rate tax on any coupons you receive from these bonds, and capital gains tax is also payable. So if you were to make a little profit between buying and selling these bonds, potentially that is taxable too, subject to the fact that you get an annual allowance that's tax-free. Everyone gets that. So in other words, no stamp, but there is income tax potentially and capital gains tax. However, you can mitigate the income tax and capital gains tax using an ISA. Now with bonds, the taxman has to decide that the bonds, each individual bond is what they call a qualifying corporate bond. Without going into the jargon, that just means the government have to decide whether it's ISA eligible, but a number of these actually are. So pop one of these into an ISA and suddenly you're still not paying stamp duty when you buy it, but you've also got protection against income tax and protection against any capital gain you might make while you hold the bond. Okay, so worth bearing in mind that yes, typically these things can go into an ISA, and for those people who are into self-invested personal pensions, that's where you basically set up a pension and you as the ultimate beneficiary of that pension pot have quite a bit of say in what the fund buys. Potentially you can direct money into what are called retail corporate bonds. So there's just something to bear in mind, and you get tax breaks in both cases for doing so. So that's worth bearing in mind. Next thing, only 2 more points to go. Watch out for this, minimum subscriptions. Now, terrible writing there, but minimum subscriptions. Basically, when you buy shares, you can just buy one if you want. You just look up the Tesco share price and you decide how much money you've got to spend, 150 quid, and you buy as many shares as £150 buys. Not true with these retail bonds. Just watch out for this. For example, the National Grid bond, the minimum subscription is £2,000. Alright, so if you're not planning to invest less, at least that amount, then these are not for you, full stop. And you then buy in increments above that of £100. So they're a bit sort of clunkier to buy than shares, if you want to see it that way. Alright, and the same is true of the Tesco retail bond versus buying Tesco shares. Alright, so that's worth bearing in mind too. And the final point is where you buy. These bonds, these retail bonds, these ones I've mentioned that are being made available to you and me, private investors as opposed to institutions, are set up at the London Stock Exchange through a special order book service which brokers and your broker should be able to access. But the point is, not all brokers, as a matter of course, offer access to all retail bonds. Alright, so basically you don't expect necessarily to just be able to go to your online trading system and see retail bonds listed. It may be that you can't buy them that way. You need to pick up the phone, and it may be you need to pick up the phone to a specific broker. Now a lot of the big brokers will happily offer retail bonds, but it's something to check out with yours, and also how you do it. You need to do it to speak to them over the phone, for example, before you dive in and buy them. Alright, so retail bonds have a place potentially in every investor's portfolio. National Grid have offered something which is inflation linked and sort of inflation proofed, and that's going to prove quite popular, I think, at the moment, especially given the government's withdrawn its national savings and investments inflation proof certificates. Meanwhile, you've got other quite big issuers offering reasonably decent fixed coupons, okay, at relatively low default risk. And let's face it, how many places are there at the moment where you can get a decent income? The answer is not many. So retail bonds are, I think, going to become more popular, but just be careful. Do not be persuaded by any advisor who says, well, they're broadly similar to shares. They're not. There are some fairly key differences, but once you get your head around those differences, in other words, once you understand what you're buying and what some of the risks are, they certainly right now, some of the better ones, have a place, I think, in every private investor's portfolio.